Welcome back to Factful Finance. Imagine this. You're considering an investment, but you're not sure if the risk is worth it. Ever wondered how investors calculate whether an investment's returns justify the risk? Well, what if I told you there's a formula that can give you a clearer picture of that? Let's dive into the Capital Asset Pricing Model, or CAPM, and see how it works. The Capital Asset Pricing Model, CAPM, is one of the most important concepts in financial economics. It helps us understand how risk impacts the expected return on an asset, making it a cornerstone in both personal and institutional investing. But here's the catch. Many investors often overlook the very principles CAPM is built on, leading to costly mistakes. So let's break it down step by step. At its core, CAPM is based on the relationship between the expected return of an asset and its risk, measured by beta. This formula essentially tells us how much return we should expect, given the risk of an investment relative to the broader market. But here's why it matters. When we know how much risk we're taking, we can make better investment decisions. Let me walk you through the formula. Expected return equals risk-free rate plus beta. Market return, risk-free rate. The risk-free rate is typically the return on a government bond, something so stable, it's considered essentially free of risk. The market return is the average return of the market as a whole, often represented by something like the S&P 500. And beta? Well, beta tells us how much risk an individual stock has relative to the market. A beta of 1 means the stock moves in line with the market, while a beta greater than 1 means it's more volatile than the market. Now let's say you're considering investing in a tech company, and you're wondering, how much risk am I really taking here? That's where CAPM comes in. For example, let's take a fictional company, Novatech. This company has a beta of 1.2, meaning it's 20% more volatile than the market. The risk-free rate is 3%, and the market return is 8%. Plug those into the formula, and we get expected return equals 3%, 1.2, 8 plus 3% equals 3%, plus 1.2, 5%, 9%. So if you're investing in Novatech, the expected return, given its risk, would be 9%. But here's the key. This isn't a guarantee. It's an estimate based on historical data and market assumptions, which means it's crucial to use other tools and analysis to make well-informed decisions. It's important to note that CAPM isn't foolproof. Some critics argue that it oversimplifies the real world, especially since it assumes that markets are efficient and investors are rational, which isn't always the case. But when used properly, CAPM remains an incredibly useful tool for assessing risk and making more informed investment choices. So, why should you care about CAPM? Well, if you're serious about building a robust investment strategy, understanding CAPM can be a game changer. It gives you a framework to determine whether the potential return of an investment justifies its risk. It also helps you compare different investments, ensuring you're not overexposing yourself to unnecessary risk. But remember, finance isn't just about formulas. It's about strategy, research, and the ability to adjust your approach as markets evolve. And as you continue learning, it's essential to consult with a financial professional who can offer personalized guidance based on your specific goals. Which part of the KM did you find most useful? Drop a comment below and let's discuss. And hey, if you found this breakdown helpful, don't forget to subscribe. There's plenty more financial wisdom where that came from. And just a quick reminder, this content is for educational purposes only. Always consult with a certified financial professional for personalized advice tailored to your specific situation.